Right. So if you have checked the book that I've sent on the platform, it is about candlesticks. Okay. And then when you start reading the book, it says that the candlesticks are the language of the market, or the candlestick is the language of the market. And if you are to relocate to any foreign country, if you relocate to a foreign land, the only way that you understand the people is when you learn their language, right? So that you can easily communicate with them. You can easily transact with them and then all that. What it means is that whatever field that you find yourself in, is best you understand the language of that field. Okay. So that you can live effectively and then comfortably, right? So if the candles are the language of the market, then there is the need for us to understand what the candles mean. There are a lot of information about the candles that I cannot treat everything this evening. That is why I've sent you the book. I'm going to mention the most important parts, right? Then you go through the book. The book will do justice to the rest. All right. Okay. So for the candles, we have bullish candles and bearish candles. So we have two types of candles, right? Two types of candles. Some people call it candlesticks, right? Now, why do we call them candles, right? Some of them, if you look at them very well, they look like the candles that we use in our houses, right? Especially look at this one. If you observe this one keenly, it looks this one and that. They look like a handle, right? This is a body, and then you see that thread where it mostly lights, right? It looks like that. That's why we call them candlesticks, right? And then you can see that on my screen. I have some in white and others in black. Why are they not of the same color? So one is signifying sell pressure, the other is signifying buy pressure. For the colors, you can set it according to your preference. Let me show you something. You see that over here, the colors are different, right? You see red and then green. This one, I have done the setting this way because I prefer my chart to look like this. So this is the default colors. The red for sells and the green for buys. The red signifies sell momentum. The green signifies buy momentum. Okay. So in an uptrending market, yesterday we saw what an uptrending market is. In an uptrending market, you are likely to see that market is dominated by the green candles. Whereas in a downtrending market, you are likely to see that the market is dominated by red candles. That is how it is. Okay. So over here, the white ones are my bullish candles and the black ones are my bearish candles. Okay. Now, they have some important features. They have some important features. So I want you to concentrate on this candle right here. I'm talking about just this one. Okay, just this one. We want to learn about it. Now we call this the body of the candle. This one, we call it the body of the candle. The entire shape. Okay, that's the one that looks like a rectangle. We call it the body of the candle. And then you see that, let me take this off. You see that it has some thin line, right? Sometimes it's just one. Sometimes you see two. Sometimes you don't see anything at all, right? Now the thin lines are called ticks. Sorry, wicks. Some people also call them shadows, and then others call them tails. Anyhow you want to name it, it depends on you, right? We call it the wick or the shadow. The wick or the shadow. Okay. Now, they are not just there for what do you call it? For play or something like that. It has a meaning. Everything that you see here has a meaning. We will try to talk about some of them. So if you see a candle such that it has a very long body and very short wicks, just like this one, if it is red, we see that it is a strong bearish candle. If it is white, if it is green, so I'm talking about scenarios like this. If it is red, we say it's a strong bearish candle. If it is green, we say it's a strong bullish candle, right? So in my case, the white one, this one is a strong bullish candle, whereas this one is what? A strong bearish candle. However, if you see that it has a very long upper wick, right? So you see that it has two tails, wick or shadow. It has two of them. We have the upper and then the lower. So this is the upper wick and this is the lower wick. So if it happens that the upper wick is longer than the lower wick and even longer than the body of the candle, then we see that that candle signifies strong sell pressure. Some people refer to them as reversal candles because when you see these candles, it's telling you that the previous trend is coming to an end and then the opposite is about to resume. So some people call them reversal candles. And it is very evident. Look at what was happening here. We had white candles throughout. And then upon the formation of this candle, we saw that it repeated or it printed continuously bearish candles. So upon the formation of this reversal candle, it gives us an idea that the market is about to reverse. Like I said, when you read the book, it's going to talk about a lot of these things. Okay, so I'll pause there. One thing I want you to know is that the candle has parts. This is the body, like we said, and this is what? The wicks or the tails. Now, for a bullish candle, we have its opening price here. We have its opening price here, right? So we call it the open, represented by O. So look at this. If you can see my cursor, you see that up here. Oh, I didn't record the session. Okay, I'm doing that. So if you look at the top here, right, where my cursor is, you see we have O. The O represents the open. Okay, so this candle, it has it open here. Okay, and then the C represents the close. So this candle has it close here. It has it close here, 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 right? So if it happens that the opening price is smaller than the closing price, then we say that candle is a bullish candle. So technically, if you want to identify a candlestick, it's best you identify it by the opening price and the closing price and not the color of the candle. The reason is that I can decide to change mine to the opposite, such that the red candles will be my bullish candles and the green candles will be my bearish candles. It doesn't really matter. The colors don't really mean anything. It's the opening price and the closing price that actually brings the difference. So the same way for a bearish candle, we have that the opening price is at the top and then the closing price is what? At the bottom, which means the opening price is bigger than the closing price. And so if it happens that way, then we say that candle is what? A bearish candle. I hope up to that point, everything is clear. Okay, so the rest, the book will do justice to that. But then we have something here. Aside the open and the close, we have high and low. So each candle has a low and then a high. So for this candle, we have that the high is here and the low is here. The same for the bearish candle. The high is here and then the low is here. Over here, this is the high, and then this is the low. I hope that is clear. Okay, so these are the parts of the candle, and you can use that to interpret what the market is doing. Now look up here. We have a 4 hours, right? You see that when um I put my cursor on it, it comes as well 4 hours. That is telling us that we are using the 4 hour time frame. And so every single candle that we see here represents 4 hours trading activities. It represents 4 hours trading activities. That's what it means. We can change the time frame. So I can change it to the daily time frame. And that will mean that each candle that I see here represents 24-hour activities, right? 24 hours activities. That is what it means. So this means that if I should switch from here to 4 hours, each of the 24-hour candle is going to be splitted into 6, because we have that 4 times 6 is giving us what? 24. So if we break down the 24-hour candle, we are going to have 6 4-hour candles. And that is why when you change the time frame, the chart will automatically change, because it is as the candles are expanding, either expanding or shrinking, depending on whether you are zooming out or zooming in. Okay, I mean on the time frames. Okay, right. So these are what daily candles or 24 hours candles. It's the same way, if I move from the 24-hour or the daily time frame to the 1 hour time frame, what is going to happen is that each of the daily candles is going to break down into what 24 candles, because we have 24 1 hour candles in the daily candle, right? That's basically it. And that's why the moment you change the time frame, the chart is also going to change. So I want you to pay attention to something. When we start talking about market structure into details, you will see that whenever you change the time frame, the market structure is going to change. So it is best you really understand what the market structure is, so that you don't get deceived. Other than that, you will see a buy on maybe the lower time frame, you'll be buying. You go to the higher time frame and you see the market is selling. Then you go and close it and you start selling. It's important we understand the significance of these things. Okay. Right. So that's just a bit about the candles. Okay. And then the time frame. Now I have a video on YouTube that will show you how you are going to navigate your way around the trading view interface. Okay. Because after here, you can start trying your hands on some analysis. So you can go to YouTube. There is a video on how to navigate the trading view interface. Watch that and you'll be able to do some of the things that we are doing. Okay. Today, we are not going to go into details with the technical analysis, but the little we are going to do, you should be able to start something for yourself. All right. So yesterday we established that there are three main market structures. We have the trending market, where we have what an uptrend and then a downtrend. We have the ranging market, and then we have the choppy market. And we established yesterday that for a choppy market, we are not going to take any action, or we are not going to trade when the market is consolidating. Choppy is the same as consolidating. Okay. So we are going to trade when the market is either trending upwards or downwards, and then when it is ranging. So we want to look into details how to technically define an uptrend, or how to technically tell that a market is in an uptrend. All right. So when a market is in an uptrend, theory, in theories, we expect that the market will behave like this. In theory, we expect that the market will behave like this. Of course, it doesn't always look like this. But then we say that this right here is called a higher high. Okay, so the ones that are marking, they are called higher highs. Right? These ones are higher highs. Okay, so I want to write higher highs. Okay, that's how we denote them. Higher highs, higher high, higher high. All of these are also higher highs, but for the sake of time, I will leave it here. Right below the higher high. Okay, so let me define the higher high. So when the market is going up, okay, when it is appreciating, it gets to a point and then it starts retracing or it starts reducing in value, it starts dropping in value, it starts depreciating. So the point where it got to right before the reversal is what we call the higher high. So you can see that the market was going up, it got to this point and then it came down. That is the higher high. Here, the same scenario, it was going up, it got here and then it came down. That is a higher high. The same for this. This is a higher high, right? Now, right beneath the higher high is what we call the higher low. Higher low. This one is called higher low. Higher low. Higher low. Okay. So the higher low is what? After the retracement, where the market gets to right before it goes up. That is what we call the higher low. Okay. So these are all higher prices in the market, but they are lower than the higher highs. That's why we call them higher lows. And then these are higher prices in the market, but they are higher than the previous highs. And that's why we call them higher highs. Okay, so they are all highs, but they are higher than what the previous highs. These are all highs, but they are higher than the previous lows. So we call them higher lows. I hope that is understandable. Okay, so this is how you are going to define an uptrending market technically. So if you tell me that the market is in an uptrend, then you should go on to show me where you are identifying the higher highs and the higher lows. I hope that is also clear. Okay, so let's go on. Let's look at the other side. When the market is dropping, it does something like this. When it is dropping, it does something like this. And so the point where it gets to right before it goes up, you see, when it is dropping, the point that it gets to right before it goes up, that place is known as lower low. Okay, like this. That is a lower low. Like this one, it is a lower low. This is a lower low. And this one is also a lower low. This is also a lower low, right? And we denote that by capital L, L, lower low, lower low. So I believe that we are guessing what these ones will be called, right? So where the market gets to, right, when it is going up, right before it reverses and continues to fall, that place is known as what? A lower high. Okay, lower high, lower high. Okay, so it means that in a downtrending market, the market is characterized by series of lower lows and then lower highs. Whereas in an uptrending market, the market is characterized by a series of higher highs and higher lows. I hope that is clear. So this is how technically you are going to define a downtrend and then an uptrend. So after we have completed the course, if I ask you what is the structure of this market and you tell me it is an uptrend, you should be able to show me where the market was forming higher highs and then higher lows. Okay. If you tell me it is a downtrend, you should be able to show me where the market was forming lower lows and lower highs. I hope that that is also clear. All right, let's look at the next one. So we talked about ranging markets, and this is how the ranging market looks like. Okay, we see that the market is trading within a confined zone, like it's defined in a region. Now we say that a ranging market has, it looks like this. So the market is doing something like this. So we say a ranging market has equal highs. So it has equal highs, okay, and then equal lows. Okay, so you see all of these are highs, but you see they are aligning around the same level. So we see they are equal highs. And then all of these are lows, but they are aligning around the same level. So we call them equal lows. So when we see this in the market, then we see the market is what? Ranging. The market is trapped within a specific region. Okay. This thing also happens in the markets. It happens in the markets. Okay. So how do we take advantage of such conditions, such market condition? So when you meet the market doing this, when the market is ranging, you are going to sell. Whenever the market comes around the high, you will take a sell. And then whenever it comes around the lows, the equal lows, you will take a buy. So it means that in a ranging market, we can benefit from the selling, the drop by selling from the equal highs, or we can take advantage of what? The appreciation by buying from the equal lows. That is how we are going to trade in a ranging market. I remember I mentioned yesterday that in an uptrend, we are going to buy, right? We are going to buy in an uptrend. So how do we buy? So the highs that we identify, these highs, right? We will wait for the market to go through the highs. When it comes back to it like this, okay, let me extend this. When it comes back to it like this, we will take the buy from here. Okay, the same thing here. You wait for it to go through your line. When it comes back to it, you take the buy. Same for the sell market. When the market is doing something like this, right? When it breaks the lower low, wait for the market to come back to the low and then you take your sell. Now, this approach is what we call the break and retest approach. So it means that in an uptrend, mark the immediate higher high. Wait for price to go above it or go through it. That is known as a break. Then again, wait for the market or price to come back to the level you marked as a higher high. That is known as what? A retest. Upon the retest, you take your buy. In a downtrend, mark the lower lows. Wait for price to break the lower low. Again, wait for it to come back for a retest. And then upon the retest, you take your sell. I hope that is clear. So this is how we are going to buy and sell in an uptrend and a downtrend, as well as what? A ranging market. So what we are going to do now is that what we have done right now, what we have seen here is just theory. Let's go to the chart, the actual chart. Let's go there and see how the market actually plays out. Let's see how the market actually behaves. And then we know how we are going to take advantage of it. So the first thing that we want to do is that we want to be able to tell the trend of the market. That is very important. We want to be able to tell the trend of the market. And okay, so I want a very simple site so that we can all get it. Okay, so I want you to pay close attention to this part of the chart. Okay, this region, only this region. I don't want you to go beyond it. Now, within the region, we see that price is doing something. It went up here, came down a bit, went up, came down, went up, came down, went up, came down, and then it went up here. So if you look at how the market is behaving, it looks like it is progressing upwards. If that is the case, then this is an uptrend. How do we mark the levels? We say that where the market gets to right before it drops, that is what? The higher high. So we will mark it like this. Where the market will get to right before it drops here is the higher high. So I mean here. And then the same thing can be found here. And then the final one was found at the top here. Okay, so this is how you are going to mark your higher highs. Ideally, you wait for price to break it. When it comes back to it, then you take your buy. If it doesn't come back, don't take the trade. Let it go. You will have other opportunities later. The market presents a lot of opportunities every now and then. So don't force the market. Okay. I think I can use this one as an example because there were a lot of retest here. Now let's look at this side. We see market going up and then right from here, it came down. It went up right from here. It came down. It went up right from here. It came down. Then it went up. It came down. It went up. And you can see, right? So what it's doing is clear or it's similar to what we saw in a downtrend. And we can see that these levels are the ones that we termed as what? The lower lows. These are the lower lows, right? And something interesting happened here. You see that markets, after forming the low, went ahead to break it and then retest it and it sold. The same thing here, he broke this one, went to retest it, and he sold. Same thing happened here, broke this one, went to retest it, and he sold. That is how the market behaves in a downtrend. This is how the market behaves in a downtrend. Okay, so I think the buy was not a very good example, so I'm not going to look for another one. So this one is a clear uptrend. We have price going up, coming down, 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 and then going up, and we can end here. So the same way we have that here forms our higher high. This side forms the higher high. This side too forms the higher high. Then the top also forms a higher high. Okay, so if you are following the lesson, you should know what we are going to talk about. So you can see clearly that over here too, the market has done justice to the levels. Look at it, it broke. So this is the high. It broke it here, came for a retest, and it bought. Came back again, went ahead to break this high, retested the high, and then it bought. Same thing here, retested and then it bought like that, like, and then it goes. So this is how you are going to buy in an uptrend. And that was how you are going to buy, sell in a downtrend. Okay. Now, this is a basic way of analyzing the market. We have several ways of analyzing the market. This is the least, this is the simplest among them. This is the very basic. So if you understand this, you realize that every other analysis that you learn, you will see this playing out in it. You see it playing out in it. It actually works if you know how to apply it. Okay, it works a lot if you really know how to apply it. Right. So for today, that is just what I wanted to show you. To show you how you can technically define an uptrend or a downtrend. How to technically define a ranging market. And then for a choppy market, we have said we will not trade it. So there is no need wasting our time on it. Okay. But you should make sure you understand this, the uptrend and the downtrend. If you don't even understand the ranging market, make sure you understand the uptrend and the downtrend, because that is what is going to cause you to make money. An uptrend means that the market is appreciating in value, and that is why we are buying. A downtrend means that the market is depreciating in value, and that is why we are selling. Another thing that I want to mention is that we have what we call the support and resistance line. Support and resistance line. So I'm going to do something like this. So let's assume that this is the current price of the market. So take it from me. When the price is above your level, when the price is above your level, just like we can see here, we see that that level is a support level. I'm talking about this. It is a support level. When the level is below another level, when the price is below a level, we see that that level is known as a resistance. Okay. So pardon me, I want to write them. This is a resistance. And this right here is known as a support. Okay. So when the market is above the level, that level is known as a support. When it is below a level, that level is known as what? A resistance. If that is the case, it means that the moment the market breaks the resistance, now the price is above the level. So the resistance has become what? A support. What this means is that when a resistance is broken, it becomes a support. When a support is broken, it becomes a resistance. So technically, if we are buying from a support level, the moment price breaks it, it becomes a resistance. So if it comes to a retest, we will sell from the level. And mind you, it is no more a support, it is now a resistance. So what we are trying to say here is that we buy from a support level and then we sell from a resistance level. We buy from a support level and we sell from a resistance level. Now, these are a bit technical. So if you are very new to trading, maybe this may be a little confusing. Of course, I've tried my best to communicate it in a simple way as possible, but I know that some of you might still find it a challenge. No problem at all. The main mentorship, we are going to spend about 90% of our time learning about technical analysis. So don't worry, we are going to do a lot of these analysis. By the time we are through, you can pick any market and analyze it and go on to trade the market. Okay, that is where we are taking you to. All right, so at this point, I will pause and give you the opportunity to ask your question.